Can India's growth potential rise above 6.5%? C. Rangarajan analysis. India's economy grew 7.8% in the first quarter of 2025 to 2026. Impressive, right? But does it mean our potential growth rate has increased? Economist C. Rangarajan, former RBI Governor, says not yet. He explains that India's potential growth, the rate we can sustain without creating inflation, still stands around 6.5%. Why? Because the real drivers, investment and efficiency, haven't changed much. Let's break it down. Backhand index, finger pointing down. The gross fixed capital formation rate, GFCFR, basically, how much of our GDP is invested in building factories, infrastructure and machines, has been stuck at around 34-35% for the last 3 years. Meanwhile, the incremental capital output ratio, ICOR, which measures how efficiently we use that capital, stays around 5.2. The math is simple. Chart with upwards trend. Growth equals investment divided ICOR. So 34% divided by 5.2 is almost equal to 6.5%. If we want growth above 6.5%, either investment must rise or efficiency must improve. Now, the public sector has stepped up. Its share in total investment rose from 21.6% to 25%, mainly in infrastructure. But that momentum is slowing. Central government capital spending growth dropped from 39% to just 10.8%. The private sector, on the other hand, has reduced its share from 37% to 34%. And that's the key problem. Without higher private investment, we can't lift long-term growth. Future prospects. Tick. AI and new technology could improve productivity. Warning sign. But aging capital and weak global trade may offset the gains. Net exports already turned negative again in early 2025 to 2026, showing how fragile the external environment is. Bullseye. Bottom line, India's potential growth remains around 6.5%, which is still strong globally. But to create more jobs and move faster, policymakers must unlock private investment and raise efficiency across sectors. Speech bubble. What do you think? Can India break past the 6.5% barrier? Comment below.